All right, everyone, welcome back to Daily Market Narrative, the show where we try to make sense of this financial roller coaster we all seem to be strapped into. I'm Dave, and today we're diving headfirst into the narrative that's got everyone's knickers in a twist: the Fed, inflation, and whether we're all just whistling past the graveyard of higher for longer interest rates. It's the story that's got the market doing that classic cha-cha of up, down, and sideways, all while trying to figure out if the Fed's got a secret handshake with the economy or if they're just winging it like the rest of us. Persistent inflation, a surprisingly sturdy economy, it's a combo that's forced everyone to rethink when, or even if, those rate cuts are actually going to materialize. And as you know, when rates stay higher for longer, valuations tend to get a bit cozy, especially for those shiny growth stocks and anything AI-related. Now, on the flip side, we've got corporate earnings, particularly from the big tech wizards of AI, which have been acting like a superhero, swooping in to save the day and keep those major indices from plummeting into the abyss. But the million-dollar question, or rather the multi-trillion-dollar question, is how long can this go on? Can the Fed pull off that mythical soft landing, or are we destined for a bit of a bumpy landing, perhaps even a crash landing? It's a real head-scratcher, folks. Now, before we get completely lost in the weeds of economic theory, let's give our trusty charts a once-over. We're looking at the SPY ETF, and on the weekly charts, it's still hanging in there, looking pretty bullish. The daily chart, well, it's showing a bit of a wobble, but according to the tea leaves, or in this case, the squiggly lines, this weakness only becomes a real cause for panic if we see support levels at 640 and 620 go bye-bye. Until then, the chart ninjas are predicting a move higher, aiming for a respectable 665. So, as long as those key levels hold, it seems the market still got a spring in its step, despite the daily drama. All right, let's pivot to the news cycle, because apparently the world didn't stop spinning just because the Fed might be taking its sweet time with those rate cuts. First up, we've got U.S. stocks slide as tech rout deepens, hurt by climbing yields, from Bloomberg. So, the stock market decided to take a little dip, with tech stocks leading the charge downwards. Why? Because those pesky Treasury yields are climbing, making growth stocks look about as attractive as a dial-up modem in a fiber optic world. This little sell-off is basically the market saying, uh-oh, inflation's still here and the Fed's not blinking. The impact? Well, if tech keeps taking a beating, we could see more volatility ripple through the broader market, and investors might start to get nervous and hide out in more defensive plays. Plus, those higher yields mean borrowing gets more expensive, which, as we all know, can put a damper on economic growth and those all-important corporate earnings. Next, and this is a big one for the tech geeks out there, watch U.S. pulls TSMC China waiver, tech stocks fall, also from Bloomberg. Apparently, Uncle Sam has decided to revoke a waiver for TSMC, the big chip maker, regarding its operations in China. This is the kind of move that sends shivers down the spine of global supply chains and makes geopolitical strategists have a field day. The market impact? This could seriously mess with TSMC's business in China and might force a split in the global tech market. For us, it could mean higher prices and more uncertainty for companies that rely on TSMC's chips. So keep an eye on that. It's a real doozy. Then we have Treasury yields jump on prospect of U.S. having to refund tariff money. 30-year yield tops 4.97 from CNBC. So, yields are doing a rocket launch, with the 30-year now sailing past 4.97%. The reason? The possibility that the U.S. might have to give back money it collected from tariffs. This little tidbit raises eyebrows about increased government borrowing and, you guessed it, more inflationary pressure. Higher yields are like a speed bump for businesses and consumers, making it pricier to borrow and potentially slowing down investment. It also makes U.S. debt look more appealing, but the reason for the jump suggests underlying economic jitters. Switching gears to global energy markets, we've got Russia clinches major new gas pipeline deal with China as West shuns supplies, from CNBC. Russia and China are apparently getting even closer, signing a big new gas pipeline deal. This is Russia doubling down on its energy exports to Asia while the West continues to give them the cold shoulder. The market impact? This strengthens Russia's energy hand in Asia and further isolates it from European markets. Expect some potential shifts in global energy flows and, maybe a slight tweak to energy prices in both Europe and Asia. Now, for a bit of political intrigue, French far-right builds momentum as premier nears ouster from Bloomberg. The far right in France is apparently on a roll, with predictions suggesting a strong showing in upcoming elections and a potential ousting of the current premier. This could mean some pretty significant policy shifts in France, both domestically and on the international stage. The market impact? A far-right win could shake up EU policy, especially on trade, immigration, and economic integration. This might create a bit of a wobble for businesses in France and the wider EU market. Keeping with the geopolitical theme, we have Kim Jong-un takes the train to China to meet Xi and Putin from Bloomberg. Yes, you read that right. Kim Jong-un is on a train heading to China to hobnob with Xi Jinping and then meet with Vladimir Putin. This summit is expected to focus on regional security and, the usual friendly banter between these leaders. The market impact? This could signal a tightening of alliances between North Korea, China, and Russia, which could definitely stir the pot in East Asia and beyond. Any agreements or policy shifts could certainly impact regional stability. And finally, some good news for a tech titan. Alphabet jumps as U.S. judge says Google can keep Chrome from Bloomberg. Alphabet stock took a nice little leap after a judge ruled that Google can hang on to its Chrome browser, despite that big antitrust lawsuit. This is a huge win for Google, easing worries about regulatory action against its bread and butter. The market impact? This positive ruling could give investors a boost of confidence in Alphabet's future, and it might also signal that the regulatory environment for big tech might not be quite as dire as some had feared. Now, let's peek at what's coming down the pike in terms of economic data. We've got a whole smorgasbord of housing data with the MBA Purchase Index, 30-year mortgage rate, Mortgage Market Index, mortgage applications, and the Mortgage Refinance Index. All those will tell us if people are still feeling confident enough to buy homes, or if they're all just staring at their mortgages with a worried frown. Then, there's total vehicle sales and Redbook year-o-year, giving us a snapshot of consumer spending. We'll also hear from Fed officials, Kashkari and Mussolem, who might drop some subtle hints about the Fed's next move, or just offer more delightfully cryptic pronouncements. And don't forget the JOLTS job openings and quits, which are like the economic gossip column, telling us about the labor market's mood. Factory orders and a 17-week bill auction will also be on the menu. And finally, the Fed's Beige Book, which is essentially the Fed's report card on the economy, giving us a regional rundown of how things are really going. So, plenty of data points for the market to chew on and, of course, overreact to. And that, my friends, brings us to the end of another daily market narrative. The Fed's shadow looms large. Inflation is sticking around like a bad habit, and the charts are doing their best to keep us guessing. Remember, the market is a complex beast, driven by 1,000 narratives, some more compelling than others. Keep your wits about you, stay informed, and for goodness sake, don't forget to like and subscribe. We'll see you tomorrow.